Now, let's discuss how Social Security benefits are taxed. We've set aside the earnings test. Now the government has a plan to tax your benefits no matter how old you are, drawing your benefits, if your provisional income exceeds the thresholds on the screen. Married filing joint, once you're over $44,000 of this provisional income, 85% of your Social Security benefits can be taxable on your return. What is provisional income? Great question. Let's look at this example. It is adjusted gross income, which includes your federal annuity, traditional TSP withdrawals, spousal income, anything else that's built into your adjusted gross income, plus your tax-exempt income, plus half of your Social Security benefit. That is how we derive provisional income. We then apply that number to the limitations to determine if your Social Security will be taxable. Now, let's assume for a moment that you are on that $44,000 bubble. Again, after having met with hundreds of federal employees, as a CPA myself in helping clients through difficult tax planning strategies, we see this quite often. We see clients retire, draw from their TSP on top of their provisional income at $44,000. When they take that dollar from the TSP, they're only in the 15% tax bracket in my example at $44,000. So the TSP is taxed at 15% federal. We will not discuss state tax in this presentation. Subsequently, we then add 85 cents of a Social Security dollar to the tax return at 15 cents on the dollar, which is another 13 cents of taxation, creating a total tax effect of 28 cents. So yes, that $1 drawn from your TSP when your provisional income is on the bubble in the $45,000 range for married folk creates a second tax on Social Security benefits. This effect of 28 cents on the dollar is quite high, maybe even higher than what you're paying today in taxation. Make sure you know where your provisional income will be as it relates to your Social Security, your federal pension, and your withdrawals from your traditional TSP. The potential excluded sources from income would be qualified dividends, which are rare, Roth IRA and Roth TSP distributions, non-taxable pensions and annuities, inheritances and gifts, and life insurance proceeds. These items are potentially not included in provisional income. So the question you must ask at this point, how are you going to control Social Security taxation? One of the ways to control it is to look carefully at the way you're saving your money now in anticipation of that withdrawal phase and how your withdrawal of assets could positively or negatively affect your Social Security benefits.